Thank you, Hammy. Not as nice a introduction as Carl's, but I'll take it. We have, unfortunately, the ignominy of taking the graveyard shift. I do apologize for that. We did speak to management, but they wouldn't accede to our requests. Last year, we had a brilliant professional poker player who was significantly more entertaining than us. I do apologize for that as well, but hopefully the content will make up for some of our shortfall. The topic of our discussion is really regime shift, asset allocation implications. It sounds like something that comes out of ChatGPT if you type in confusion, but hopefully, with Stuart and hopefully from some clever prompting from my side, we'll have a little bit of a clearer idea on how we think about the problem and how we try and help ourselves and our clients navigate the investment, complex investment environment. I think, one of the really interesting things, certainly, I'm not quite sure where we should sit.
In the middle, apparently.
In the middle,
yeah,
okay.
For the cameras.
Oh, I see. Great. Thanks, Stu. One of the really interesting things about us is we claim not to do any forecasting, and then we give you expectations of asset returns and some assumptions around those. So like Carl, I'm a bit sheepish about that sort of thing, but it really helps to contextualize how we think about things and where we look for opportunities. What we will hopefully try and cover today will be, things like interest rates, inflation, our views on those sorts of things. Stu loves that sort of question, being a dyed-in-the-wool episode acolyte. But the other sort of more complicated aspect of this audience, for your benefit, Stu, is really, we've now had to contend with higher foreign allocations in our investment portfolios. So hopefully you'll give us some sense around, how you would think about the problem, blank sheet of paper. But before we get into that, do you mind giving us a bit of an introduction on the episode way?
Sure. And I'll talk about the history as well. We haven't got many slides, but there's one at the beginning. The team I sit in originated in working on the asset allocation for the Prudential UK's life assurance assets. And as part of that, Dave Fishwick, who's now the head of the team and who developed the episode approach, originally started as an economist. And his job was to forecast things like German CPI, German GDP, to feed back to the strategy group and committee to try and come up with some asset allocation. And that's how he began in the late 1980s. He quickly realized that this way, which is still widely pursued by many parts of the industry, is a pretty damaging way to try and generate returns through asset allocation. So you discover very quickly you're playing a game that everyone else is trying to play. You're using public information. You might get your forecasts right, you might get them wrong, but largely they're going to be pretty much in line with everyone else's. And even if you're different and right, the markets don't reward you by doing what you thought they were going to do. He was reading the behavioral finance literature at the time, and it became clear to him that far more important than trying to get this kind of information edge about macro fundamentals is to be reactive and wait for the occasions where the market itself gets caught up in short-termism, these behavioral forces of panic and complacency, and these are what we call episodes. So a vast bulk of the time, the market can be very, very efficient. We can't believe we've got a God-given right to be able to know better than the market what inflation's going to do, when the Fed's going to move next. Far more important is to wait for the market to move from, for example, at the beginning of 2023, attaching a 100% probability to a recession and an amazing performance for bond markets, to only 10 months later talking about nothing except higher for longer. Those wild swings in the sentiment, often in our view caused by price itself, so people get scared by losses or overexcited or worried about missing out and begin to chase returns. Being far more reactive to those is what we do on the episode team. So Dave put that into practice in 1999 in this episode strategy, which was a pure TAA, active asset allocation strategy. It was rare at that time for the Prudential to maintain faith in active asset allocation. You're in the end of the tech bubble. Your equities had smashed bonds for many years. Most in the industry thought there was no point to doing active asset allocation. All you had to do was find who was going to pick you the next .com stock. Fortunately, Prudential didn't fall into that trap, and TAA was able to generate a huge amount of value by avoiding and shorting equities in that tech bubble phase. And we've continued to run that strategy ever since.
Yeah, can I just chime in there? So, you're describing a process that for the sort of uninitiated, sounds as if you bumble along, click F9 on your spreadsheet, and then you wait for these events that are quite scary and a lot of trauma for the market. How do you actually, can you give us an example of how that works in practice?
Yeah, so what we do, we have 3 key points. So we are strong believers in valuation being your best guide to prospective returns from any asset over a significant time horizon, so 5-10 years plus. So that's our starting point. That tells us we want to be leaning to go long of equities post-GFC. We want to be leaning short of bonds in 2021 when they've got negative real yields. That tells us how we want to play, where we predisposition is. That's not sufficient. As we all know, value signals can be illusory. You fall into value traps, and it can take you so long for them to work for you that it becomes unhelpful. So
you get fired by your clients.
You get fired by your clients,
Right.
but also on relevant time horizons, it can be particularly damaging.
Yeah.
But that's our starting point. We never want to counter those value signals. I've got a slide as well that will talk about exactly how we visualize that. But as I say, it's not sufficient. Value signals, when associated with what we would look for as symptoms of this episodic behavior, which is where the market is panicking or getting overexcited, you often see very rapid price action.
Yeah.
So particularly around declines, a great example for us was the 2020 initial COVID panic. A very scary environment, markets gapping down. We will look at how rapidly the price is falling. We look at how correlated it is. So we understand that it's very scary, but we can say the market here isn't making a considered assessment of fundamentals.
Yeah.
It just wants safety, and it's selling everything indiscriminately. So that's where, if we believe in our approach, we have to force ourselves, no matter how difficult it feels, and indeed, no episode that we invest in feels easy to us even after all these years. We have to be contrarian to that. So that's an example of us going long. The example of us going short is by the end of 2021, when you're looking at bonds with low real yields. At the same time as delivered inflation is picking up, your CPI now data in the US is hitting things like 6%, and yet bond yields in the US are lower than they were pre-pandemic.
Yeah.
So we don't have to forecast anything ourselves about what inflation's going to do. We have to then understand, why is the market ignoring this data? And we'll begin to look for signs of herding, anchoring to the past. Is this a good time to begin taking on that very strong valuation signal to short these bonds? And indeed, by the end of 2021, you're actually seeing bonds rally against that background as people get a bit scared of
the recession's coming, isn't it?
The recession's coming, so on. So those episodic flashpoints are those tactical opportunities which tell us when are better than usual times to back these valuation signals in size.
I mean, it sounds quite similar to a talk that we heard earlier with the public fix team, where you're not actually, you're doing the work pretty much continuously beforehand, and you're quite ready to act when the market gives you the opportunity. Is that a fair sort of assessment?
Yeah, hugely. So we...
if you'd said no, we would have had an issue.
We're totally consistent with them. So we are very patient when we need to be, which is a huge characteristic of how that fixed income team work. Even David Nee has been working in the team. He began in that same unit that Dave Fishwick started off at in Prudential as well. Richard Ryan and the other managers, Eva and so on, within the fixed income world, are people that we engage with and have a shared set of beliefs about the nature of what are the market inefficiencies that are presented to us to exploit.
Right. I mean, this is very easy to do at a sort of global scale. Can you touch on a little bit about how you've helped certainly South African clients do the same for their portfolios?
Yeah, so we spent a lot of time in the early 2000s. Probably I say early 2000s, so not me. I wasn't employed at that time. I was still
probably in kindergarten.
I was still at university, or even before. I wasn't doing this. But perhaps in a similar environment today, South African clients very concerned about their domestic economy, very keen to maximise overseas assets and hold very little rand-denominated assets. When based on our approach, you're looking at an environment where those valuations are extremely attractive back then. You're seeing all the negative sentiment, even these periods of episodic behavior that suggest now is actually not the time to be tactically shorting those types of exposures. As with today, we all know the risks, but because we all know them, you're possibly and very likely to be well compensated for them.
Yeah.
So that was an example for South African clients specifically tackling on that very issue of managing your overseas versus domestic exposures.
Right. I mean, you know, on the topic of externalizing your assets, I mean, obviously, the higher foreign allocation, you know, you're buying a little bit of extra currency volatility, and some would say, you know, yeah, that's fine. You can just hedge all of that out. I mean, how, you know, what's your sort of view on, you know, hedging out your sort of 100% of your global equities, or is that a sensible thing to do? Because, you know, if you express those returns in local currency, a lot of the outperformance is actually the spot currency moving.
Yeah.
So you're sort of undermining your investment case by doing that. You know, how would you sort of frame the question from blank sheet of paper for someone who's suddenly now got from 30%, you can go up to 45%? What, you know, what's a sensible thing to do?
I'm going to put this question back on you once I've given my thoughts, because, you know, that's your job to some extent.
Right.
From a strategic standpoint, from my point of view, the addition of overseas assets, yes, you can do the work on what it does to the volatility of your portfolio using, you know, relatively arbitrary time horizons. That's useful for risk management, but far more important is the genuine diversification against eggs in one basket risk. So yes, you're adopting extra volatility potentially because of the currency element to it, but you need to think about what is the real purpose of me diversifying? Is it about smoothing my returns? The industry still has an obsession because it's easy to measure on that shorter term volatility rather than thinking about what I would consider real risk, which are permanent impairment of some of your assets in terms of future returns. So adding overseas exposure is key and very important, I would say, from that theoretical standpoint. In terms of hedging, the convention clearly in most of the academic work is that you fully hedge your bonds
back into local currency.
Back into local currency, and you leave your equity. The theory being that your currency vol will swamp the returns on your bonds, so it makes it unimportant. There is a challenge to that. So if you're a Japanese investor and you hedge your overseas bonds, all you're getting is a return once you're including the cost of currency hedging back, you're getting a return very close to your domestic bond market. Fortunately for South Africa, you don't have that problem. you have very high domestic yields. So hedging is a far more, for me, viable option today. But I think this is a chance for you to say what your thoughts on the subject.
Well, I mean, look, I struggle with that because, you know, one of the reasons you would want to buy international assets, certainly global bonds, is the fact that, you know, when you look at the risk of global bonds, and, you know, we'll use correlation as a measure here, you know, the asset that correlates or decorrelates your portfolio the best is global cash and global bonds. So if you're buying your global bonds, hedging out, you know, the currency, then you're basically unwinding all of that. Plus, you know, the sort of, a lot of you have heard me say this, but we've got high real yield in SA. So it's very hard for you to build a valuation case for buying global bonds hedged. It used to be quite straightforward. If, you know, when credit spreads were around 300, 400 basis points, then you could get a diversified, you know, basket of semi-decent, you know, investment grade credit, and we're still paying you 150, 200 basis points. If you're a little bit racier, you could, you know, probably go into the high yield space. But that was when, you know, yields in South Africa were at 3% real. Now you're sitting at 7% real. It's pretty challenging.
Yeah. So I'd say two things to that. So again, thinking about that eggs in one basket risk, if you're sitting in an emerging market whereby your risks are primarily correlated across all your assets. So at the same time as your bond, the typical definition of an emerging market, or one that we like to use in terms of trying to think about them, is that currency weakness begets inflation, begets policy tightening, begets a squeeze on growth. So all your may or may not be associated with foreign outflows as well.
Yeah.
So all your assets are getting hit at the same time as your currency is weakening. So hedging out the possibility to benefit from domestic rand weakness is potentially limiting your ability to have that eggs in one basket risk managed. So that's on that point. I would agree from that standpoint. The other thing I would say in terms of the tactical opportunity today, it is an environment where certainly in our funds, we do like South Africa. We bought some episodically in the summer of 2023 when you got a bout of independent weakness, which we captured, and that was a very relatively short-lived episode. Today, you're not so...
That was Lady R, ladies and gentlemen.
That episode is largely unwound, but the value case is still there. So we don't have huge positions in South Africa, but we are leaning slightly long of the currency. Some of our funds have the South African bonds unhedged as well. So based on our framework, going against that valuation signal and going against sentiment that's already very negative would be something we'd be very wary of doing.
Right. I don't want to nerd out on the sort of intricacies of how much foreign you should have in your portfolios, but the sort of the episode philosophy. There's controversially, obviously, you use some passive vehicles to express those views. Can you unpack some of that for us? Because there's the challenge that if obviously what you want to buy when you're buying episode is a skill, but if all you're using is passive vehicles, then where does the actual alpha come from?
Yeah. So for us, it's all about the top-down tactical opportunities. So we need to be nimble and dynamic to move in and out of our exposures. And there's two reasons why passives fit into that. Their liquidity, just most obviously. Also, when we look at the experience of the things we've managed over the years, including one where we've allocated to active managers, if we're taking on emotionally difficult events, a classic example was trying to buy Sweden when there are all sorts of fundamental concerns about Swedish equity markets. You allocate to Sweden. Back then, you didn't get your performance data much later. You didn't get much look through to what the underlying manager's doing. The underlying equity manager is equally as scared as everyone else. So he's totally put all his stuff into cash, defensive equity assets. Right. So we're sat there, patting ourselves on the back for an amazing episodic trade because Sweden's bounced. The manager we've allocated to hasn't bounced with it because he's fallen into the same trap that we're trying to pick up on. So we like the transparency of passive products and their nimbleness. That said, here at M&G, where we do use some actively managed funds, we know the managers know well. We have good access to them to know what they'll be taking on. Right. And that people like Carl Vine briefly sat in our team as well. He started out in our team for a very brief period. Yeah,
I could tell. He's using that episode.
There's some similar language there. So we have a good sense that some managers we have a good handle on, but we certainly want the drivers of alpha for us to be about that tactical responses, not the underlying stock selection.
Right. So we've spoken a lot about the episode way. Can you give us a little bit more tangible examples? There's a few I can think of, quite contrasting examples. So the China trade early this year, and quite different to the China trade that we engaged in the back end of 2022. Mexico trade currently, we often don't like talking about live trades because sometimes they're actually underwater. But I haven't checked what the ticks are today. It probably is.
It's underwater. Don't worry about it.
There was a gilt trade. Can you just take us through?
Yeah. So actually, we've got the slide for China is a recent one, and it's a good example again of these wild swings.
Wait, before you carry on, do you want to plug the performance?
Oh yeah, well
not coming back.
I know people don't want to hear a fun pitch, especially in the graveyard slot, but starting in the early 90s and having late 90s and having a process like ours means you've been able to generate really strong returns, and critically, for us, the value element and the episodic element means we really want to preserve. We want to add value for asset allocators through our tactical asset allocation in periods like the bursting of a tech bubble or the sell-off in bonds in 2022. Right. 2008 is a struggle. These things can happen. They will challenge a value approach like ours. That's an example of a bad environment. But when you're getting expensive assets selling off, you're almost semi-permanently impairing those. Yeah. It takes you a very, very long time to make that money back. And if we're generating positive returns for asset allocators, when we overlay our approach or in our own funds, that's hugely valuable. And again, we talk about regime shift. Up until 2019, you haven't really needed a great deal of tactical asset allocation. Yeah. Your equities and bonds did extremely well.
See.
Yeah, not only performing well, actually, it's probably understating the bond returns over those phases, that index. You're getting a great return from both over that time period, and whenever you have a problem with your equities, your bonds diversify you. By the end of 2019, even before COVID hit, we were saying this is going to be an environment where to repeat the type of returns that investors have been used to over the last decade, they're going to be needing to do very different things. You can't sit passively long of equities and bonds, given where the bonds were sitting in valuation space and where a lot of the equities as were that weren't giving you any compensation for those bonds selling off. And that built the conditions for 2022. And so the last 5 years have been where we say, right, this is where we want our strategies to be doing well, where you need active asset allocation.
But the patience to be able to pull it off as well.
And as I say, the emotional difficulty of doing things that are often very contrarian in their manner.
Yeah.
But that wasn't the question. The question was about China, which is a few slides on. Yeah, it's a good example because we initially bought some Chinese equity at the end of 2022. So 2022 was a very unusual year where we moved from being particularly short of bonds to moving long of bonds within the course of about 3 months. It's very rare to see valuation signals shift enough for you to be changing your directional view. But when the bonds did get, quote unquote, cheap and episodically sold off in and around October 2022, the equities went with it. And at that time, we lent towards China, that we were buying a broadly diversified basket. Clients, sell side, everyone was telling us that China was uninvestable. Literally uninvestable. You could not, there was no justification for buying it. By the end of 2022, you'd had a 50% rally through to January and February. Dave Fishwick and Gautam, who was here early, did a marketing trip in Asia, and every person they spoke to was asking why we reduced our China exposure. We were on platforms. Everybody's favorite trade was China at the beginning of 2023. By the end of 2023, you've seen some sharp weakness, to say the least. And you've even seen periods of rapid price action, but they weren't enough in themselves to make us respond episodically.
Why is that?
Yeah, it's a good example of why we're not purely mechanistic. So you could often have said it was cheap. What we look at is the sentiment around the declines, and also you look under the bonnet. So the China market would sell off periodically and quite rapidly to cheap levels. But if you actually looked at what was going on within the index, the market was being quite discriminating and punishing particular areas while leaving others alone. It would be tech stocks, it would be education stocks, it would be overseas investors.
Gambling stocks.
Yeah. That was very different by the time you hit December and then especially February this year. It was a correlated decline in China. It was the language alongside it is the stuff we love to hear, which is when people say, oh, I like China long term, it's cheap, but I don't want to buy it right now because I don't want to catch a falling knife, or I want the dust to settle, or I can't see a catalyst. All that stuff is music to our ears because it's telling you it's probably people selling because of what the price has just done, not because they're thinking clearly about the underlying fundamentals. And more often than not, these episodes work in our favor without any obvious catalyst, although the press might then reinvent a story after the fact. So it's a good example of when we're going to engage on the long side and also why we didn't previously. But what you'll also see there is we had an initial nibble in December and then doubled exposure in January. So if you talk through Mexico, which is a good example right now, a live one, you've seen a rapid sell-off.
Idiosyncratic.
Idiosyncratic, which we like to diversify our basket. You're seeing attractive valuations. When you look at the sentiment, it's not quite as extreme as that. It's not talking about price. It's talking about what does this mean for certain areas.
Not yet, anyway.
So we're not building. We always want to be prepared. We're never going to get our timing spot on. Although that slide looks like it. That's why we show it. But we need to be prepared to be scaling into losing positions. That's key for us. So risk management for us is all about making sure we've got room to buy into an episode as it goes against us. So Mexico, painful. You'd love to get your timing spot on, but because we have this valuation element, as the trade goes against us, it's getting more attractive. It's becoming more episodic. It's getting cheaper. We don't want to be caught up putting on stop losses and things like that. In fact, we think that the market's own obsession with those kind of things creates the type of volatility that we can exploit more often than not. So that's a recent example, China and Mexico this
And
year.
Mex.
Yeah.
Can you just elaborate a little bit on that risk management portion of it? Because it sounds as if you are buying things that are falling and committing more capital to something that's going down.
Yeah.
I mean, what sort of things you think about before you say, this is my max long position or max short position?
Yeah, so we've got to consider the volatility of the position in its own right, quite simply, and its correlation with other themes in the book. Something like a China will be behaving independently in January. At that time, most other equity markets were very, very strong. So we can go, there is a China-ness to this, which if we're right about the episode, can actually diversify. Either it might not go down if there's a problem for other equity markets because it's already so cheap, or it can rally in an independent way. So we'll have a larger than otherwise position on that basis. Then we think about, well, what else are we doing in our portfolio at the same time? We built large, long bond positions in October 2023, amidst that, whatever they call it, the biggest sell-off in bonds in 100 years, depending on some analysis. We were of the view there that with yields where they were, even by December and January, they'd rallied a lot. They had a scope to diversify because people were so getting to the point of being very optimistic. They're even more optimistic today, but certainly complacent about growth risks, arguably. Complacent's a bit of a loaded word, but certainly those bonds can rally in a way that we're happy to add China alongside those. They can protect in a way that they couldn't have done in 2021.
Yeah. So starting valuation is quite important. Risk appetite is very much dependent on what regime you're participating in.
Yes, yeah. So it's about our level of conviction, obviously, but also about what else we have in the book. We're never going to own assets that we don't like just because they'll diversify. Yeah. But if we can find cheap assets that have an episodic element that can behave differently in different scenarios, then that gives us more scope to add other positions alongside.
Right. And I mean, if we can get a little bit into the viewsy side of things, I know you love this sort of thing.
Yeah.
So go on, son. I mean, how do you guys think about, this higher for longer regime, higher nominal interest rates? Don't really know where real interest rates are going. Corporate profitability, the fixed team mentioned fiscal deficits and the funding thereof. I mean, are those features that, you sort of think about and build trades on, or?
Yeah. So we think hugely about the nature of the regime. So if we'd employed a straightforwardly mechanistic valuation approach, you would have spent long parts of the last 20 years being short of bonds because you've been comparing them to some sense of fair value, compared to a prior regime. So we need to observe, so what is actually happening to inflation? And you can see the rise of globalization, you can see the technological advances and so on. They are supportive to assessing what some notion of fair value is. What we don't want to be doing is sitting down and saying, we've got a strong view on higher for longer in October 2023, because that's when people were talking about it very loudly, but they're only talking about it because the bonds have just sold off aggressively on them. So we need to consider those things. If the regime is changing, it happens so slowly, and the market is typically anchored and slow to adjust to that new reality. So you do get time to observe. It can be painful if it does adjust more quickly, but we want to be thinking about those things with a cool head and with a very long-term perspective, not forcing ourselves to hold those views at exactly the wrong time from your tactical standpoint. That said, we are clearly very cautious about what are the conditions for the regime going forward in terms of largely the power of labour and capital.
Yeah.
The reversal of globalization is a problem associated with that, but also you have presided over many decades where arguably the strength of capital plus the technological advances has been able to effectively increase supply constantly of most goods, even in the face of money printing and so on, to keep inflation under wraps. There are clear signs of that reversing. So what we then need to do is keep a close eye on the facts and wait for the market to either overreact or underreact, because the market typically doesn't have a regime length time horizon when it's moving.
Yeah. And I mean, on that regime piece, so if, the labor share is going up or has to go up to, some sort of more normal levels, does that impact how you assess, whether corporates can grow earnings by 5% real, for example? And how does that actually, is that too far, in your time horizon, or do you sort of think about it and say, actually, we won't be as long equities in this environment because we don't think they can keep growing earnings at 4.5%?
Yeah, so valuation comes first. But if you're looking at valuations of the US equity market today and a lot of other equity markets, your concern is the market is not pricing in any real hit to margins from these forces. That doesn't even need to be a regime view. That can just be a cyclical view. So equity markets in aggregate, and the US in particular, are not giving you much compensation for either the risk of weak growth and the problem of wages feeding through to profit margins, or actually any real type of higher for longer risk. So actually, when they talked about higher for longer in October, that had all gone by December. The bond sell-off you've seen so far this year is more about a short-termist cyclical picture, people's optimism about the resilience of the US economy in particular, rather than people grappling with the higher for longer discussion.
But I mean, Fabian and Carl had some, interesting anecdotes about the breadth of US equity market performance. Do you guys dabble into that sort of thing? I mean, we speak a lot about a lot of macro stuff. We hardly spend time speaking about individual stocks, but at a macro level, if one company is driving 70% of the earnings growth, you have to pay attention to it.
Yeah. So another reason we believe this approach works at a aggregate level is it's far harder to. All we're trying to do is look for cases where valuations and prices are moving in excess of what's going on with fundamentals. And once you're looking at an aggregate index, it's harder to shock those fundamentals. You can do it, don't get me wrong.
Thanks, NVIDIA.
But if you're looking at a single stock level, those individual earnings numbers can easily swamp any sense of where your fair value is. So we don't play in individual stocks in this episodic fashion. And so we need to be clear that if what's going on in the US equity market is about 7 stocks, we need to be cautious about how aggressively we want to take that on. Do you want to step in the way of that? Rather than a generic, I would say at the moment we still have a degree of comfort in all asset pricing that is reflected in equity markets, but we don't want to directly short those 7.
Those 7 stocks. But you're doing that by being underweight.
We're doing it by underweight, and also the scale of it is also about risk management again. So we're thinking about, with this continued exposure on the long side to bonds we have, what if we're wrong about that?
Yeah.
And what do other asset prices do? If your bonds get shocked in a October last year type scenario, if it's about inflation picking up again, then what happens to your equity market? So playing in some equity markets that we already think look to be offering you pretty low levels of compensation for most risks, that can help us while our bonds are losing on the other side of it. So we're always trying to construct the portfolio to balance these themes out.
Yeah, I mean, so far, I guess the locus of the conversation is around an absolute sense of, being able to go long and short. We obviously run long-only portfolios for a lot of other clients. How does that expression change? Your benchmark construction. How do you actually calibrate your risk positions? How are you thinking about, for example, if we are worried about, South African bonds, and you guys love South African bonds, obviously there has to be some level of thinking about the overall risk in the portfolio.
Yeah, so by and large, all we do is apply our absolute mindset, and you can overlay it because you're playing in relative space to those long-only funds. So most positions map more or less. If you're sitting in a fund that's structural neutrality is 75% long equity, then you might think, I'm going to be a bit wary about adding a load of emerging market unhedged bonds in terms of the risk properties of this position.
Right.
Because in those scenarios, if you're concerned about the equity anyway, you're already a little bit short, but you're still going to be dominated by that. You're going to look for diversification elsewhere rather than sort of thinking, oh, I've made a great choice because I'm underweight my equity, but at the same time you've stuck on a load of emerging market bonds. So when you're in that long-only space, you do, consider the absolute drawdown and the nature of that, and you think about your playing field.
Right. Now, Stu, the sort of really interesting thing about the multi-asset approach is that we're quite clear about where our expertise lies. And in bringing together different assets, we're hoping to generate, something of a decent and a better ride for clients rather than the individual asset classes. Is time horizon a feature of how you think about the world, and how does that actually interplay between being strategic and being tactical, and your risk budget application, especially when you know, a lot of things are cheap and you have to think about where am I getting best bang for my buck?
Yeah, I mean, time horizon is key for us thinking about the balance between tactical and strategic. So all trades will combine an element of the valuation piece and an element of the episodic piece. And you would expect, or we would expect, that for a tactical episode, it should be working in our favor, you know, at the longest between 12 and 18 months. If we think something's an episode and it hasn't recovered 18 months down the line, we were wrong about it being a panicky sell-off.
Yeah.
Because it just
Turkish lira being a case.
Yeah. You can get a new event that causes a problem, and then we have to take that one on. But in general, these tactical opportunities, we're thinking of a shorter time horizon. That's what we think where we can add value. And then on the value case, you're leaning longer as well.
You're trying to harvest the risk premium.
Yeah, exactly. And it certainly shapes our predisposition.
Right. I'm wary of the time, so I guess we can probably spend a few minutes talking about some of our favorite assets at the moment.
Yeah. I'll just explain what this slide shows. So on the left-hand side, you've got cash rates in number of markets, less some long-term consensus expectation for their inflation. Not our own views, the market's own consensus.
This is the forecasty bit.
This is other people's forecasty bit against which we measure other people's price responses. So the blue bars are real cash rates. The green bars are doing the same thing for bonds, moving out from developed market bonds to EM bonds and credit. And then on the right-hand side, you've got an earnings yield on equity, which is just a P/E ratio expressed as a yield. Now, before I say anything, it's clear that the elephant in the room are those blue bars on the left-hand side. So you can see there, you've got that inverted yield curve. So the worry for us, even though we're long bonds today, and we think that you get rewarded if there's a growth problem, the challenge is where we want to be contrarian more often than not. Our worry is the degree of conviction that the market still has that things get back to quote unquote normal. So that's a real risk to our bond positions. We still like US Treasuries. Yep. We like the long end of the UK curve and the German bonds. Against the market's own view of where these things are going to go, they offer good value. Even if inflation sits at 3 long term in the US, you're getting an attractive real yield there and potential for a lot of asymmetry for it to rally in a growth problem. If those cash rates don't come down, every bar on this screen has to move up. And that is disastrous for the investment industry in terms of the products we're selling around the world, and there's a real challenge. Clearly not our base case today, given our positioning, but it's one where you're going to once again, if you get a prolonged regime shift to a 2022, or, a 2022 over many years, you've got real problems, and you're going to need something that can be flexible.
And what are you looking at there? Is it inflation? Is the key marker if inflation continues to be a little bit stickier? Or
inflation and the nature of it, how the market is perceiving it, is the key issue there, but also how that feeds through to real rates. But moving forward, on the equity side, there are pockets of value today, but as I say, it's an environment where we feel the market is very relaxed about risks. I've mentioned it a few times, but relaxed about higher for longer and relaxed about growth risk. So a strategy like ours is going to be leaning cautious. So part of that cautious is about getting a balance between themes, getting those bonds that can potentially diversify, hoping to get lots of opportunities like a China, then a Mexico that are independent and we can generate different sources of return. And then within the equity space, we're leaning short or underweight the US versus some other areas. But again, these aren't hugely contrarian views. You will hear managers saying that it's not an episodic element so far. But in terms of risk management, again, if we've got the bonds on one side, can being short or underweight the US help you if you're wrong on the bonds? Right. So that's part of the consideration. Right. But a diversified set of longs against that with recently larger exposures to China and now Mexico.
We haven't spoken about currencies. Well, the rand's an exception.
Yeah. So for us, currencies, we look at carry as our sense of value. And then we're looking to do exactly the same thing. Find high carry currencies and look to be responding after periods of episodic price weakness. So that was hugely fruitful for us post the bond sell-off in 2022, 2023, a lot of currencies got taken with that on the emerging side. We're also creating a short basket that includes things like the euro and yen with very low carry, and that's worked very well. The result has been, given that a lot of EM markets, which are typically on the long side in terms of carry, now cutting rates, that carry signal is less available, and certainly it's not one where there's any kind of negative sentiment. If you look through Bloomberg, there's all sorts of strategists talking about, it's a great environment for carry now. So we do have a small book. It's pretty diversified. We have longs of things like now Mexico, Brazil, Rand, so on. In a way, the usual suspects. We've tried to structure the short side or the areas we're underweight by having some Asian currencies in there, things like Taiwan, so we don't just have the classic safe haven currencies as a set of funding currencies.
Which hurt you in a sell-off, don't they?
Which can do, and we're very conscious of that, particularly given you've just seen a very dramatic, you've almost seen an episodic sell-off in the yen now.
Yeah.
So we want to be careful about being blind to what the price has done just because the carry still looks low. So we've just shrunk that book down, basically, and diversified it. So as I say, the world is pretty optimistic. We're leaning cautious. We talk about this idea of patient opportunism. We'll be prepared, like the fixed income team, to sit relatively quietly. We did the same in 2021. We weren't chasing, the work from home US stocks then either. You sit and you
weren't long Zoom?
We weren't. No, we didn't manage to spot the episode in Zoom. So we wait and make sure we've got room to respond when the episode presents itself.